Welcome back, everyone, to our final episode of our Charlie Mike Surety Bond series. And so we have with us this morning Adam from Parity Surety Services, who's going to be talking about maximizing surety capacity. How does one go ahead and maximize surety capacity? So I'm thinking that that may kind of help me grow my business as well. So I'm going to turn it over to you. Welcome back, Adam. We're thrilled to have you. And I'm going to go into stealth mode as I did in the other sessions, and I'm going to let you kind of take it from here.
All right, thanks, Marie. So today we're going to be continuing our mission on surety bonding. During the first few episodes, we talked about what surety bonds are, what the application process looks like for applying for surety credit, and then how the surety underwriter underwrites the application and financial statements for to qualify someone for surety credit. My name is Adam Milliren. I'm the owner and surety bond specialist at Parrot Surety Services. Our brokerage is a specialty surety brokerage. We help agents and companies across the United States get surety bonds in difficult situations, or we help them succeed in maximizing surety capacity with good advice and financial analysis. The few things that we're going to be going over today. Number one, the team that you have behind you, your professional team, that's going to be super important for growing your surety program. Then we're going to go over some of the surety tools that agents and brokers might recommend or utilize to help get you qualified in situations that you might not otherwise qualify, or to help get bonds and for difficult to place bonds, the actual risks that are being underwritten. And then the last thing we're going to do is talk about increasing your capacity for single bonds and for your aggregate limit. So for the first part, your professional team. So the three things that are going to be most important for your surety bonding are going to be obviously your surety agent. The second most important is going to be your accounting firm, who's preparing your financial statements. And then third, your banker or your lender, who's providing you lines of credit for working capital or financing for equipment and real estate and stuff like that. So your surety agent is going to be number one. They're your representation to surety companies. They help you through the surety bond application process. They help you gather your application and documents. They help improve them, fill in gaps for questions that the sureties might have that they're anticipating. Your surety agent is paid by your surety company, so you don't need to worry about paying them any money up front. Even for a bid bond, there's no cost for the bid bond. They get paid by the surety company when they place surety bonds with a surety company. Their main job is to help you with your financial analysis and provide financial advice so you can align that with your business plan and grow your surety program alongside your business plan. They can also assist in looking for problematic contract language. So sometimes whenever you go to get a bond within your program limits, the surety might have a problem with some of that contract language. So before you sign any contracts or go into anything that's going to need to be bonded, make sure that you're having your surety agent look through that and help you identify any kind of problematic bond language or contract language. And as I said, they're definitely part of your business team. They need to be there whenever you're talking about your business plans for the next year, so they can make sure that you're going to be able to qualify for the type and size of work that you're going to be going after. And ultimately, your surety agent is the one that's actually giving you your bond. They're going to be billing you for your bonds and collecting that premium for the surety company and forwarding it to them. Your next partner that's going to be super important is going to be your accounting firm. I see this all the time, people using tax accountants, and that usually is not, who you want to use in this situation. If you're in government contracting and you're using, a surety program, you're going to want a GovCon accountant or someone that's familiar with construction accounting. Tax accountants, their ultimate goal is to minimize tax liability, and they don't usually present the most accurate financial picture of your company. And that's not really helpful for you, and it's not helpful for the underwriters who are performing financial analysis for you. You're not getting the details that you want, or at least not an accurate picture of the details that you want. Something that you can do is whenever you're, interviewing accounting firms to try to select one, you can get references to make sure that that accountant is familiar with your line of work and works with other contractors that do similar sized jobs as well as the similar scope of work. They should definitely prepare your financial statements in line with GAAP and utilize the percentage of completion method. Anybody that is familiar with GovCon or construction accounting should be able to prepare your statements for percentage of completion. And then they should also be able to provide you with CPA audited compilation and review statements as well. And then your next important partner is going to be your banking or lending partner. They should be familiar with construction lending. They should definitely support working lines of credit to help with any kind of cash flow stuff. And then they should be familiar with term loans to provide those loans for equipment and real estate. And whenever you're trying to work on your working capital, you might need to re-term out those loans to shift some of those current liabilities to long-term liabilities, and that can help with your bonding as well. And so building your relationship with your banker or your lender is going to be super important for these reasons. And also definitely make sure you're matching your lender to the situation. If you're a new and emerging business, you don't have a lot of capital to go off of, you're going to have to find specialty lenders that aren't FDIC backed, but are SBA approved in most cases. So just you can work with your surety agent. You can talk to your current banker. They might have recommendations on other routes you can go for other types of lending partners. And so that pretty much wraps out your professional team. Now we're going to move into some of the surety tools that you might come across when you're trying to maximize your surety credit. The first thing that most new and emerging contractors will experience or have experienced is the SBA Surety Bond Guarantee. We'll go into that on the next slide, but we'll also talk about some of the credit programs that surety companies offer on the standard market, plus situations that might require collateral, funds administration, and then some other agent or broker specific solutions. So first, the Small Business Administration has the Surety Bond Guarantee Program that helps new and emerging contractors get bonded, essentially. So the standard submission can potentially double your capacity. So on a traditional surety bond market, as you see in this picture here, $100,000 in working capital can generally qualify you for a $1 million bond. With the surety bond guarantee backing that guarantee, you can pretty much double your capacity. And this is huge for helping new and emerging contractors grow through that $1 million project, that $3 million project, and get up through, $5 million plus projects. Any kind of some special situations that this is also particularly helpful in. If you have negative equity, they'll forgive that equity, and then they just consider any kind of bank lines that you have. If you do have negative equity, it might be difficult to get a bank line, and that's when you would want to go to the SBA to try to either get a loan or find someone that is approved by the SBA and will give you a working line to really help boost your capacity for your single size projects. And another limitation that you have to consider is what your largest projects are. So even through the SBA, you're not going to be able to more than double any size of your projects. So if you've done a $500,000 project, you can most likely qualify for anything up to $1 million. Taking working capital into consideration as well. And another big thing that the SBA did just this year is they removed the requirement for audited financial statements. You'll never need audited financial statements for the SBA for their little checkbox. The surety company, however, does go through the underwriting process before the the SBA surety bond guarantee does their little checklist. So just because the SBA doesn't require audited financial statements doesn't mean that the surety company won't. But typically, if you recall from one of our previous episodes, that level is about 3 million, where surety company is going to start looking for audited financial statements. With in-house financials, without even having an accountant, you can potentially use your in-house financials for projects up to 2 million, pending that you have at least a $1 million project on your past performance. The SBA surety bond guarantee does come with an additional 0.6% administrative fee, but taking everything into consideration, you can really get access to larger projects and a larger backlog. So as long as you're still able to compete against other people for cost in those situations, that's completely fine. It's definitely worth the additional costs. And these projects can be projects up to 10 million, and I think they've even extended them. Some projects you can qualify for up to 14 million. So this can definitely support you through your first few years. But the ultimate goal is to get you to a wealthy enough standpoint that you can qualify on the standard market on your own. I did want to mention that for projects under $500,000, there's a quick app that doesn't take so much question and information. It's one page and does not require financial statements. And there's not really a hard limit on how many of those projects under $500,000 you can have, but your limitation is going to be whatever your surety underwriter approves. The SBA isn't going to have really any limitations on that. The next tool that I wanted to talk about are small credit programs. So these are good for either your first bond or if you need a bond within 1 day and you don't have any other bonds out. These are automated credit-based programs. They're not collecting any financial statements, and they can do projects up to about 750,000, 1 million. I think some companies even go to 1.25 million. The one catch that usually holds up contractors from applying to these programs is the minimum 3 years in business. There are usually other stipulations with these, such as no bankruptcies, no liens or judgments in the past 5 years, no IDIQ contracts or contracts that can be escalated in size easily, essentially. No contracts in the 5 boroughs of New York. These ones just need to go into direct underwriting because there's just an inherent risk with contracts in New York City. Typically, they only want to see standard type contracts at about 1 year or less. If they're longer, they might fit in some of the programs. Some of them might kick them out. And you definitely can't have any bonds with any other sureties, and they're going to limit any kind of liquidated damages in the contracts. And these will be a 3% flat rate. That's about what you get without taking into account the financial wherewithal of the company. And that's pretty much across the board. Every company comes in at a 3% rate. So taking into account that there may be some sort of payment terms that the surety deems as increased risks, such as advance payment or open bonded projects with other surety companies, funds administration might become necessary for a project. And so what this is, the funds for that project get paid into a separate bank account that is set up by a funds administration company. And that bank account is in the contractor's name. The funds are just managed by the funds administration company, and the project owner has to approve all the payments that are paid out. So this just prevents financial mismanagement and increases the surety's willingness to extend bonding capacity for situations where they may have concern about those open projects, advance payment, and job borrowing. The cost for this is an additional 0.5% to 0.75%, and project monitoring may also be required to during that approval of payments. Whenever they make payments, the project monitor may approve any kind of work that goes into the project or materials that go in the project whenever payments are being requested. So then the next thing that a tool that surety agents and underwriters and brokers have is collateral. So collateral is mostly used on the commercial side. It's not really used usually for contracts, but they're used on like closure type of risk, reclamation risks, and other risks that last many of years. Think about like closing mines, closing landfills, stuff like that. For contractors, if you are required to ever have collateral on something, it's likely that, it probably shouldn't even be being required, and you might want to request some sort of like funds admin over collateral, taking into account that the opportunity cost of putting up collateral is just like it doesn't go well with the contracting world. For anyone that does have to put up collateral, usually sureties only accept pretty liquid assets. Cash and letters of credit are the most common, but other liquid assets such as stocks, bonds, unencumbered real estate can be used. Um, but definitely consider any kind of time or conditions for returning that collateral as a consideration. And also note that if you're using letters of credit, there is a real cost to that in the range of 1 to 2%, and you usually get those from your bank or your lender. And then lastly, there's always, very unique situations that just require different solutions. And, having a good agent or broker that can make those recommendations or to the underwriters or know what companies are familiar with these kinds of solutions can really help you out. One of those is getting bonds back from subcontractors. Um, Another one is splitting up contracts into phases. So if there's larger like payment risk, or you're working just like at the maximum end of your capacity, of your surety capacity, those might be some situations where the surety underwriters might only be willing to write your bond if you get bonds back from subcontractors, or if the project size is too large to get the approval, your agent or broker might come back to you and work with you to see if you can split up the contract into phases that can be completely closed out. So instead of doing, one $10 million bond, splitting it up into two $5 million bonds. Um, just because if your company doesn't qualify for 10 million but does qualify for 5 million, this would enable you to keep that contract but just split it into two. And then the last solution that you have, if you're not really qualifying for a particular project or size of bonding, you can always bring in third-party indemnitors. Just keep in mind that this should be a business transaction so that you can't be accused of any type of fraud. And this is a good situation, or this is something good to look into if you want to extend your bonding capacity and you're looking to make JVs. Consider, the wealthiness of your JV partner, because that can help you guys qualify for greater amounts of bonding and bring you access to larger projects as well. For sureties, the right to sue, which that's what an indemnitor, they're just guaranteeing their personal assets to the contract or to anything that indemnity agreement is under or tied to. So the surety, the right to sue only goes so far. Surety underwriters are underwriting the company and they want to see that the business is able to cash flow, work through any problems on the projects on their own. They don't really want claim situations to come up, and they don't want to go to court and stuff like that. So really the third party indemnitor situation can only really take you so far. Um, if you really need capital in your company, maybe they would put up a letter of credit or just make an investment into your company if you have no other solutions. All right, so these last few slides are going to be, the bulk of what you should take away from all 4 episodes. We're going to talk about some of the key financial ratios. We're going to talk about cash flow. We're going to look at the big picture of cash flowing and try to help you visualize the importance of that for contractors. And then we're going to also talk about some of the things you can do just to increase your single project limits specifically. So the contractor cash conversion life cycle. So just this is visualizing what it takes to take a little bit of cash and hopefully turn it into a little bit more of cash. That's business, making money. So for a contractor, it can take a long time for that to happen. If you're a contractor putting materials into a construction project, you have to first purchase those materials. And on your balance sheet, those go into your material inventory. Cash goes out, material inventory comes in. Whenever that goes into construction onto a project, then that goes out of material inventory and into contracts in progress. And after it's actually been put into the contract or into the project, I mean, then you can actually bill that project, but you still don't have your cash. That goes to your accounts receivable on your balance sheet, and then you actually need to cash that or collect that cash for it to come back in. So whenever you consider this for like one piece of material, and multiply that by how many suppliers you have, how many subcontractors you have across all your projects, you can have a lot of cash tied up before you ever see that cash coming back in. So that's really the importance of being able to cash flow and having your lending partner that has a working line available to you to help you in those cash flow crunch situations where you're that are particularly common whenever you're really maximizing your bonding capacity and working against what the surety underwriter wants to give you. And then just a couple other things, make sure mentioning that whenever you have materials that you have to pay for, take advantage of your supplier discounts, make sure you're billing early and often, getting that money off the street and making timely payments to make your actual costs cheaper. Pay when paid clauses are a huge thing. It's kind of a contradictory statement here. If you're a prime contractor, always use them for your subcontractors. You don't want to have to pay your subcontractors if you haven't got that money in. Otherwise, you're cash flowing the project. The project owner ultimately should be cash flowing the project, and that always just gets pushed downhill. And if you're a prime contractor, you want to try to push that downhill to your subcontractors. If you yourself are a subcontractor and you see a pay when paid clause, especially on a bonded project that you're bonding, just request for that to be taken out. You're guaranteeing the performance of your work. It's financially backed. There's not any real risk there for them. So push that back uphill to the project owner, if not to the prime contractor. So finally, the key financial ratios. So I'm just going to go over 5 key financial ratios for you to have on your radar. You might want to take a screenshot of this once I get them all up here. Throughout the year, or at least once a year, you should be, once you get your year-end financial statements back from your accountant or you have them prepared, you should sit down with your surety agent, go through your financial statements to take a look at some of these metrics here. So you've heard a couple of them before. Working capital. This is super important because it is the measuring stick for your single bond limit. Keep in mind that the underwriters may make some adjustments to your current assets, but overall, you should have a good rule of thumb to know what you should be able to qualify for. Sometimes if you're a really good company, you have, pretty much once you get through the SBA and are a large company, you can sometimes extend this up to like working capital times 20. So this is an important metric to know for your single bonding limit. And then obviously the metric for your aggregate bonding limit and what you should be able to go after and have in your backlog is going to be the equity of your company. So your equity times about 5 or 10 is going to be your aggregate bonding limit. And there's going to be adjustments there. Anything that you make that the underwriter makes to the current assets will also apply to your total assets. And at any time, you can always increase the equity in your company by putting money in it yourself, getting an investor to put money in it. And then at the end of the year, whenever you're deciding how much money you want to pay yourself or draw out of your company, make sure you're also considering how much money you need to leave in your company for bonding. And then another big thing that we see a lot with discounts from the underwriters is the aging of receivable. You got money on the streets, collect it. Bill early, collect often. Anything over 60 days starts to get discounted. So just try to keep everything in that under that 30-day range, in that 30-day range. And once you see it creeping up in over 60, get on the phone and collect that money. Your debt to equity ratio. So this is how you're leveraging debt in your company. Underwriters don't like to see anything over 3.0. If you take your total liabilities divided by equity, your equity as allowed. So if you have like goodwill, make sure you take that out of your equity. That's generally not considered. And then figure out what your debt to equity ratio is. Make sure you're not going up over that 3.0. And then another thing that we see a lot with companies as they get up over the 1 million and doing larger projects over 1 million is the ratio of their accounts receivable to net worth. If you owe someone, or if someone owes you more money than the total equity of your company, that's never a good thing. Um, that gives them a little bit of power, and they can afford to fight you on payment. And if those aren't good receivables, that's your like whole company, and that's never a good thing. And I don't want to say I haven't seen that situation, because I've seen it a couple times in the past like year or so. So just be aware of that. And then lastly, here we're going to talk about increasing your single job size limits. Really, the biggest thing here is just making sure you're paying attention to your largest job size. So you can only do, you're limited to jobs up to 2 times your largest project. So that's something you need to actively be looking at and looking into, and considering against your next 1 year, your next 3 years of business, and what you plan on doing. If in 3 years you want to be doing $5 million projects, you need to be doing $2.5 million in the next couple of years. And then in the next year, you need to be doing 1.25 million. And the next, less than that, you need to hit that $750,000 project. So there really is a roadmap that can be laid out here. And then the second piece is your working capital. We talked about that a little bit on the last slide, but this is going to be, your single job limit. It's your 10 times your working capital. So how can you increase your working capital? One, you can decrease your current liabilities by negotiating your terms for your loans to extend those maturities beyond 1 year. So anything in the next 12 months is your current liabilities. Anything due 12 months or more are long-term liabilities. Your working capital is your current liabilities minus your current assets. So that's going to increase your working capital and allow you to qualify for projects that you might not otherwise. Or if you have a particular project that you're looking at and they want to see some working capital, you might be able to do this. Or you can increase your current assets by collecting any of those receivables over 60 days. You can liquidate any kind of like material inventory that you might have. Maybe you have a contracting friend who is in the same scope. See if they want to buy, your roofing contractor, they want to buy some shingles, whatever it may be. Turn that back into cash. At the end of the year, we want to make sure that we're keeping money in the company that aligns with whatever your growth model is. And you can also always bring on more money with a capital investment from current owners or bringing on new investors to enable that growth. Besides for that, that's it. So that concludes the episode on maximizing your surety bond capacity. If you have any questions, feel free to reach out to me. Adam at parrotsuretyservices.com. Always happy to provide advice, guidance, go over financial statements, whatever's needed. Marie?
Adam, thank you so much. This was amazing. The whole, a lot of times I think people think about, I just need to go apply and get a bond, because I'm going to have this work. But there really is a strategy behind increasing your bonding capacity. And so you need to have all of those key players that you've outlined in this session kind of in place. Otherwise, you're not going to be able to get to that 10 million or $50 million bond limit. And so reaching out to somebody like you and other professionals, in the finance, legal, accounting arena, it really kind of it's a strategy. And so do you recommend that somebody in I'll say a bonding industry, when they're starting out, that they reach out right away to find out what they need to do as they continue to grow? Or is it best for them to get maybe 1 or 2 jobs underneath, in their past performance, and then reach out? So let's say
Good
Marie
question. I mean, just like any other,
yeah, I
just
want to
like
be a
any other,
construction person, so sorry.
yeah. So just like with any other credit product, you definitely want to get your credit before you need it. And then also, even if you don't need bonding right now, but you're going to be going after GovCon projects above $150,000, just establishing a starting point is a big piece of it. And then once you get that starting point, your agent, if they're good with financial analysis, they'll be able to look at your financial statements with you, make recommendations, and you can forward those recommendations on to your accounting department or your accounting firm to make sure that those happen throughout the year. You can identify, what size projects you need to be going after to increase your capacity, that kind of things, kind of some of the stuff that, yeah, we just talked about a little bit. But yeah, definitely get established credit before you need it early, definitely a big help. And your surety agent, you don't really ever pay them. It's like a free business advisor resource for you that you should definitely tap into, and make sure that they're capable of that financial analysis side, not just coming from the insurance side of things.
That's a really that's a really valuable point for people to be aware of, is to make sure that, they're kind of vetting their surety agent before they jump in full steam ahead. So thank you again, Adam. I always learn something from you on the bonds, and I look forward to future sessions. So as you continue to create, new classes, do reach out. Looking forward to seeing you at future NVSBC events. And I'm going to call this a wrap for now.